What if I told you that thousands of seniors across Canada may be quietly missing out on a tax break that could potentially save them thousands of dollars every year, and the reason you haven't heard much about it might surprise you? For decades, many retirees believed that once they stopped working, their ability to reduce taxes disappeared. After all, retirement is supposed to mean living on fixed income, pensions, and savings. But hidden inside the tax system is a little-known strategy that some financial experts say could significantly reduce what certain seniors owe each year. Here's the shocking part. Many people believe the government would rather you never learn how this works. Why? Because the more Canadians who take advantage of it, the more tax revenue disappears. And while this strategy isn't illegal or secret, it's rarely explained in a way everyday retirees can easily understand. That means millions of seniors continue paying more tax than they may actually need to. Right now, as inflation continues to stretch retirement budgets and the cost of living keeps climbing, knowing about opportunities like this could make a real difference for many older Canadians trying to protect the savings they worked their entire lives to build. In today's video, we're going to break down exactly what this tax loophole is, why it's perfectly legal, who may qualify to use it, and, most importantly, how seniors might be able to benefit from it before future rule changes close the door. So if you're a retiree, approaching retirement, or helping a parent manage their finances, this is something you'll definitely want to understand. Before we dive in, make sure to like this video so more seniors can discover information that could help protect their retirement income. Right after hearing about a tax loophole that the CRA supposedly doesn't want seniors using, many people feel a mix of curiosity and disbelief. After all, if something could legitimately lower a retiree's tax bill, why wouldn't it be talked about openly? The truth is that most tax-saving strategies aren't hidden behind locked doors. They're buried in complicated rules that everyday people simply never hear explained in plain language. And for many Canadian seniors living on pensions, retirement savings, or government benefits, understanding even one of these overlooked strategies could make a meaningful difference in their financial stability. For decades, retirees have been told a simple story about taxes. Once you stop working and your income becomes fixed, there's not much you can do to reduce what you owe. Many people assume their options ended when their paychecks stopped, but the Canadian tax system was never designed to be that rigid. In fact, there are specific provisions written directly into the rules that allow retirees to manage how and when certain income gets taxed. The challenge is that these provisions are rarely explained in everyday conversation, and many seniors only discover them years after they could have started benefiting. One of the most talked about strategies in recent years involves how retirement income is structured and shared between spouses. This concept, commonly called pension income splitting, has existed for quite some time, yet millions of retirees either misunderstand it or never use it at all. When one spouse earns significantly more retirement income than the other, the household can end up paying higher overall taxes simply because the income is concentrated in one person's tax bracket. By redistributing a portion of that pension income on paper between spouses when filing taxes, some couples can effectively lower their combined tax burden. At first glance, this might sound complicated, but the core idea is actually straightforward. Canada's tax system uses progressive brackets, meaning the more income one person reports individually, the higher the percentage of tax they may pay on the upper portion of that income. When a couple is allowed to share that income between two returns, both individuals may remain in lower tax brackets, reducing the total amount paid to the government. The key detail many people miss is that this adjustment happens during the tax filing process. It doesn't require physically moving money between bank accounts. Instead, it's a reporting choice that eligible couples can elect when submitting their annual returns. For retirees who spent decades carefully building their savings, this kind of adjustment can translate into hundreds or even thousands of dollars saved over time. Imagine a couple where one spouse receives a large workplace pension while the other has minimal retirement income. Without any adjustments, the higher-earning spouse could be pushed into a higher bracket while the lower-income spouse remains in a much lower one. By splitting the pension income, the couple may shift some of that taxable amount to the spouse in the lower bracket, bringing the household's overall tax bill down. What surprises many seniors is that this option is not some obscure trick. It's written into the tax framework and fully recognized by the Canada Revenue Agency. Yet despite being perfectly legitimate, it's still something countless retirees overlook. Sometimes it's because people assume their accountant will automatically apply every possible strategy. Other times it's because retirees file their taxes themselves and simply aren't aware the option exists. Another factor that adds to the confusion is that not every type of retirement income qualifies in the same way. Certain pensions may be eligible for splitting, while other income sources might follow different rules depending on age or the type of account they come from. That's where many people give up trying to understand it. The terminology, the eligibility conditions, and the paperwork can feel overwhelming, especially for seniors who prefer straightforward financial routines. But once the basic principle becomes clear, the value of understanding it starts to stand out. Retirement is a stage of life where financial predictability matters more than ever. Most seniors no longer have the flexibility of increasing their income through extra work. They rely on what they've already saved, combined with pensions and benefits designed to support them through the later years of life. Every dollar saved in taxes is another dollar that stays available for daily expenses, healthcare costs, or simply maintaining a comfortable lifestyle. Over the past several years, conversations about retirement income planning have become more urgent. Inflation has pushed up the cost of groceries, housing, and everyday necessities. Many retirees who once felt secure are now paying closer attention to how their money flows each month. That's why strategies like pension income splitting are gaining renewed attention. They don't involve risky investments or complicated financial maneuvers. Instead, they rely on understanding how existing tax rules apply to retirement income. Another reason this topic has attracted attention is the broader concern that many seniors simply aren't told about the options available to them. Financial literacy in retirement often depends on who you talk to. Some retirees have advisors who walk them through every possible adjustment each year. Others manage everything themselves and may never hear about strategies that could benefit them. The difference between those two situations can add up to significant financial consequences over the long run. It's also important to recognize that tax planning in retirement isn't about avoiding responsibility. Seniors have spent decades contributing to the system through income taxes, payroll deductions, and various other payments throughout their working lives. When the rules provide a legitimate way to manage taxes more efficiently, taking advantage of those provisions is simply part of responsible financial planning. For many couples, the moment they learn about pension income splitting is eye-opening. They suddenly realize that the structure of their tax returns can influence how much of their retirement income they keep. In some cases, the difference may not be dramatic in a single year, but over a decade or more of retirement, even modest annual savings can accumulate into a substantial amount. There's also a psychological benefit to understanding these strategies. Retirement can sometimes feel like a period where financial control is reduced. Income sources are fixed, expenses may rise unexpectedly, and uncertainty about the future can create stress. Learning that there are still ways to manage taxes and improve financial efficiency gives many seniors a renewed sense of confidence about their long-term stability. Another interesting aspect of this topic is how often it spreads through word of mouth. A retiree might hear about pension splitting from a neighbor, a family member, or a conversation at a community center. Suddenly, the realization spreads that something many people assumed was complicated is actually accessible with the right information. When that happens, it often sparks broader conversations about retirement planning and the importance of staying informed. Of course, every financial situation is different. Some retirees may benefit significantly from income splitting, while others might see only a small change depending on their income levels and tax brackets. But the key takeaway remains the same. Understanding the option allows people to make an informed decision rather than leaving potential savings unexplored. As more Canadians enter retirement each year, awareness of these tax provisions becomes increasingly important. The population of seniors continues to grow, and with that growth comes a larger number of households navigating the complexities of retirement income. Government benefits, workplace pensions, personal savings accounts, and investment income all interact within the tax system. Knowing how those pieces fit together can influence how comfortably someone lives during their later years. Financial advisors often emphasize that retirement planning doesn't stop once a person leaves the workforce. In many ways, it becomes even more critical. The strategies used during retirement may determine how long savings last and how efficiently income is managed. Tax planning, even when it involves relatively simple adjustments like pension splitting, becomes part of that broader picture. It's also worth noting that tax rules evolve over time. Governments periodically adjust policies, thresholds, and eligibility criteria as economic conditions change. That means strategies available today may not remain exactly the same forever. Staying informed helps retirees adapt if policies shift in the future. For seniors who feel uncertain about navigating these details alone, professional guidance can be helpful. A knowledgeable tax professional or financial planner can review a couple's situation and determine whether income splitting or similar provisions might provide an advantage. Even a short consultation can sometimes reveal opportunities people didn't realize existed. At the same time, the most important step often begins with awareness. Simply knowing that these strategies exist encourages people to ask questions, review their tax returns more carefully, and explore how their retirement income is structured. When information becomes accessible and understandable, it empowers individuals to take a more active role in their financial decisions. And that's really the heart of the conversation surrounding so-called loopholes. In many cases, they're not secret tricks hidden from the public. They're provisions written into tax law that become powerful only when people actually understand them. The gap between what's possible and what most people know can sometimes be surprisingly wide. For retirees who spent decades working, saving, and planning for the future, every opportunity to preserve their income matters. Understanding how the tax system interacts with retirement income isn't just a technical exercise, it's part of protecting the financial security they worked so hard to build. As discussions about retirement affordability continue across Canada, awareness of these strategies will likely grow. More seniors are paying attention to how taxes affect their monthly budgets, and more conversations are happening about ways to manage retirement income efficiently. Whether through pension splitting or other legitimate provisions, knowledge remains one of the most valuable tools retirees can have. So if this topic caught your attention today, consider it a reminder that retirement finances still deserve careful attention. Even after leaving the workforce, the decisions made during tax season can shape how comfortably someone lives year after year. The more people understand the options available to them, the better equipped they are to make choices that support their long-term well-being. And if you found this explanation helpful or learned something new about how retirement taxes can work, make sure to like this video and stay connected for more insights that help seniors protect their income, understand their benefits, and navigate the financial side of retirement with greater confidence.